All right. Good morning, everybody. We got a CPI day. There was a suggestion that perhaps CPI data was leaked because of the extensive buying that we had going on yesterday. And it turns out that it wasn't, or, if it was leaked, then it wasn't like a massive leak where everybody knows. Instead, it was a Goldman Sachs analyst who had given he basically did what I did over the weekend and put out a Goldman Sachs paper that said if the CPI is, I don't remember his range, but let's say below 7, then we could see a 10% move in the S&P, a 10% move. And he's not out of line. The last CPI was 5%, and through the year this year on CPI day, we've seen moves of 3%. So, as I alluded to over the weekend and yesterday, the chase that's going to come from this, if this turns out to be a bullish move, the chase is going to be epic going into the end of the year. We're very likely going to roll over in January and dump it all back down on everybody's heads. But into the new year, if the numbers are, even remotely close to being in line, this market's going to go, oh boy, it's going to go. And so people were front running that yesterday, and that was pretty interesting. If you were able to watch the flow in, the volume, especially with options, but, futures traders too, it was like someone turned on the fire hose, and it was nonstop. Pretty impressive. So it wasn't a leak, which I guess is kind of good. The leaks tend to bother me. That somebody can get a wink and a nod and manipulate the game. I just find that a little frustrating. But no leak. If it misses and comes in hotter than anticipated, oh my goodness, it's going to be bad. Like I've said many times before, when they start saying they know, oh, we know it's going to do this. We know it's going to, you don't know. I don't know. Nobody knows. Got to let the data come in. And what they do is they just ask a bunch of people, like, hey, Bobby, what do you think? You think it's going to miss or hit? Hey, Janet, what do you think? It's going to hit or it's going to miss? That's all they're doing. They're just asking a bunch of people. And after asking 20 or 30 people, they say, all right, well, the consensus is we're going to hit. We're going to come in hot. We're going to come in light. They don't know. If it does come in hotter than anticipated, the drop to the downside will also be epic. The squeeze will it will be a sight to behold either way. China right now is having a significant issue with COVID. They had remained in, serious lockdowns throughout the last few years, trying to moderate this issue. So their society has not built up the antibodies that open societies have, right? We've got the weaker variants. And at some point, it's almost like you want to get COVID just so your body can build antibodies on these weakened variants. Well, China's population hasn't had that opportunity. And now that they've reduced COVID restrictions, they're getting overrun. Their hospitals, their government infrastructure is starting to unravel a little bit. So they're having some issues. That's definitely something to kind of keep your eye on. It might expand more by the end of the week. Like we talked about before with the inflation, the Fed don't want just one number, right? They want to see a consistent trend, and they want that trend to be abating. They want to see that things are continuing to fade off from peak levels. And what we're reading here on the European market wrap, do it this way so I can highlight it a little bit. Forecast a 7.3% consumer index. This is just a different data point, but it shows a trend. It'll be the 5th straight decline at lowest levels. This is the kind of thing that they want to see, a continuous trend in a single direction on all of their different data points. Today, the Bank of England has one speaker, Bailey. And we're going to get some numbers from OPEC, which, trying to gauge how much this is going to impact anything compared to CPI. It's kind of hard to see how it could even begin to stack up. Just remember that energy is directly connected to inflation. So you want to constantly keep track of what's going on in the energy markets. We do have additional auctions today at 1 o'clock. That kind of throws into question any sort of 0-day play that you might want to do. Wait until after 1. Yesterday, the additional auction was a little violent. It didn't stick, but it was certainly shocking. So CPI, and then we've got an 11 and then a 1 o'clock auction. And that 1 o'clock auction is the 30-year. The 30-year is one that you really want to keep track of. It's one of the bigger benchmark, and it also ties directly into housing. It's certainly one, right, to keep watch. So we are getting a little bit of a push from that Goldman Sachs tweet from their analysis. They're talking about 10% if CPI is less than, call it 7.0. And then their projections were that we could see 2 to 4% if the CPI is less than, say, I think it was 7.4. I don't have the exact specific numbers that they were using, but we don't necessarily need it, right? It was just the idea that CPI today has the capacity to really rock this market. And it's very likely not going to have an effect on how big of a rate hike we get tomorrow. That's basically set in stone. We're getting 50 basis points. Now, what I just said, it kind of proves what I was talking about earlier. We don't know for sure we're getting 50. Powell said we're likely to get 50. All of the analysts have said we're likely to get 50, but we don't have it yet. So, I mean, imagine if they do hit us with 75. That would certainly be a gut punch to the market at this point. I guess it was there all the time. Made it too late. This is the range that was within the options chain over the weekend. I just plotted it out on a candle chart. You can see that on the monthly, it would actually take us down right below the monthly 50 EMA. And for an upside move, well, there's no moving averages up there. But we would be looking at a significant breakthrough. Here on the weekly, it's a good way to kind of look at it. We're looking at these lower highs and lower lows. And since it's kind of spreading out as it goes, it's a little bit of a megaphone pattern. It's a falling wedge. At some point, sure, we're going to break to the upside eventually, someday. The key thing, though, is this 4,300 level. If we do manage to get through that level and we get up here, it starts to break the technical analysis, right? Because we'll actually have a higher low. Another thing while we're on this time frame is a lower high. We don't yet have a lower high. And for what they call a full set, you need 2 higher highs and 2 higher lows. Or, if you're headed to the downside, 2 lower highs and 2 lower lows. That's a full set. A full set is a confirmed trend. We don't have even 1 higher high and 1 higher low yet. We only have this consistent lower high and lower low. We are starting to pinch. The distance between the 50 and the 200 is shrinking. We're getting wedged in here tighter and tighter. The range is not bad yet, but at some point, one of these two are going to break. We're either going to finally get a definitive break above this 50 and stick it, or we're going to drop below that 200. I put out a video yesterday about a YOLO trade that I entered into on Friday. Since we have a pretty good idea that we're going to see a tremendous move in the market, I bought a very far out of the money call and a really far out of the money put. Now these trades, they're either going to win or they're going to lose. There's no middle ground. There's no way to save it. So you don't want to spend a lot of money on these because they really would need an epic move just to even see profit. Well, the call that I had bought, because of this explosive move yesterday and because volatility had not abated during that move up, those calls were actually printing some pretty decent profit, even though I had went really far out of the money. So what I ended up doing is locking in those gains and keeping the trade. And I made a small video on that. Basically, I had bought a $100 call. And then because the move was so strong, I was able to sell a call for more than $100. At which point I locked myself into a no lose trade. When you build a debit spread on the call side, generally you buy the one closer to the money and you sell the one farther away. The difference in their cost, if you look at, say, the mark, if you buy one for $1.02 and you sell one for 75 cents, the difference between them will be your debit. Well, I bought something for 95 cents and then I sold something for like $1.30, $1.20. I can't remember the exact dollar amount, but I sold something for higher than I paid on the one that I bought. So it's in the shape of a debit spread held as a credit. I cannot lose that trade. And it's 15 points, 15 strikes wide, right? So I went from a trade that had a chance to lose about $100 to now a trade that no matter what is going to make at least 20 cents, $20, and has the capacity to make $1,480. Well, actually, that's not true. $1,520 if it was to get max profit, which it's not expected to get max profit. That's not the idea that we're aiming for. But so when you're in a trade, you've got a lot more choices than just closing it down as a winner or a loser, or even more choices than rolling. All right, the volume this morning is within our expectations. No surprise here at all. So we can just turn that one off. We have an MDP, a missed daily pivot. Markets generally hit their pivot more than 80% of the time. So the fact that we have not hit it stands out. There is a strategy for it, but it's not my strategy. I didn't develop it. I am thinking of building one, but I don't have one. Because of the really big move that we had yesterday, it's worth coming out to the daily chart and looking at the distance from 10. This literally, it's what I built this indicator to do. If we get a big move in the market, I want to know, have we moved too far? I really don't like the language, overbought or oversold, but even though I don't like that language, it certainly fits. And that's kind of what we're asking here. Are we overbought? Did we move so far yesterday that we're in overbought territory? And the answer is no, we didn't move too far at all. We're only 1.3% above that 10-period daily moving average. And the turnaround point has been somewhere closer to 3% on the year. So we could easily move another 1.7% away from that moving average before even considering the idea that we're oversold or overbought. So we're not overbought at all. We haven't moved too far. We didn't move too fast. This is a daily, however, and the daily tends to work with us a little bit. So we want to swap it over and check the weekly. Asking the same question again. Did we move too fast yesterday? Did we move too far? We are 2.4% away from the 10-week moving average. And while that's not the worst or the farthest we've gotten from it this year, it's pushing it a little bit. We could still move another 1.5% and be okay, but we're kind of touching the edges there. I'd say 1% more from our current location. That'd put us at a 3.4%. That's about as overbought as we want to see. And we would very likely see a pause or a reversal at that point as the market would consolidate and kind of reverberate at that point, digest it a little bit. We do not have a market maker move this morning, which is a little bit of a surprise. I don't trust that. We know that today is epic and the moves are very likely to be extreme. It doesn't make sense that there's no market maker move showing here. This says we have a $97 move from our current location higher or lower today. That would be a 1 standard deviation move. What I recommend is to look back at the year and recognize that we could easily move 3% today. 3% would be easy to hit today. We're not reaching here at all to see a 3% move. And that would be at 41.45. So let's do the same thing in the other direction. That gets us down to 3,900. So we could go as high as 41.50 or as low as 3,900 today. And that would not be considered an outside move. It would not be considered extreme or reaching. That's a 3% move, and we've had those this year. I'm not saying that we're going to move that far. I'm just saying that it's definitely on the table. There's no amount of technical analysis, no pivot point that will contain or control the move that we're going to see when the report comes out. But as I've talked about before, when we get an economic report in the pre-market and we get these really big candles, consider this really big candle a gap. And price is going to want to go back and close that gap. I know it doesn't look like a gap because, I mean, you can see the candle, but it's a liquidity gap. It creates a liquidity vacuum. So price is going to want to fill that gap. Now, if it's, well, it wouldn't even matter which side. Just because we do get this big move does not mean that price is going to spend the rest of the day trying to fill it today. That's what we've been seeing a lot lately, is that we get the economic whiplash, we get the really big candle, and the rest of that day is spent fixing that big candle. But it doesn't have to happen in the same day. So that's something to keep in mind too, especially with FOMC tomorrow. I do believe that there's still time between now and Friday that if you were to focus on a YOLO call and a YOLO put, there's no reason to pick a side necessarily. You could, I mean, if you wanted to do it that way. But if you were to buy one of each, the strike that you would pick would be dependent solely on how much money you're willing to lose. There's no reason to try to go in and, use any kind of options market structure and say, well, I'm going to use this delta at this expiration. None of that's going to fit, right? The only thing that's going to matter is how much the darn thing cost. The ones that I bought, I spent $1 on them. So worst came to worst, I was going to lose $1 on the upside and or $1 on the downside. I was comfortable with that kind of risk, that kind of loss. Between now and Friday, the capacity to make a tremendous move in the S&P is still there, even after CPI comes out this morning. So don't feel like, oh, I missed it. I would have done it if I'd have known. You can still do it. You would just have already missed the first event, right? But there's still one more to go. All right, 10-day, 30-minute volume profile. We do have some volume resistance overhead, but as I was just saying, it won't stop price when CPI comes out. If it's positive, we're going to punch right through that like it doesn't exist. The reason we still want to recognize it, though, is if we've gone through it on the upside and then we go to pull back like a Busby and validate old resistance as a new support level, that 4080 would be our support level that we'd be looking at. To the downside, this air pocket of risk still exists, right? We could fall right back down through it really easy. When we broke out and began running through it yesterday, we ran through it quickly because there's nothing here resisting us, right? It's an air pocket of risk to the upside. Well, if we flip over and start heading back down, the same thing applies. There's nothing here to hold us back, which means that pivot point from Monday and Tuesday really doesn't have any value to it. See how we went through it really easy. Nothing was there to hold us back. That's why just drawing a line at a pivot point, yesterday's high, yesterday's low, something like that, just drawing the line at a pivot point doesn't do any good if there's no reason behind it. It's not going to assist when price comes down and hits that level. We have a VPOC from yesterday now. Doesn't have to be perfect, just kind of get it close. And we'll carry that line forward until we come down and hit it at some point, eventually, maybe someday. We still have one overhead at 42.30. When we get there, we expect to see a reaction in price. These are not support and resistance levels. We wouldn't lean on them and expect them to necessarily stop price from doing anything, but they do offer like a first touch play. Energy continues to get whacked to the downside. And one thing worth noting, I had someone point out this head and shoulder the other day. Yes, that's a head and shoulder. And yes, that's the neckline and the break. But head and shoulders are supposed to be up here. they're at the top of a trend because they're reversal plays. You got price going up, and then you get this head and shoulder pattern, and then you get price going down. It's not supposed to be price going down, and then you get a head and shoulders pattern, because it's a reversal pattern, not a continuation pattern. It shouldn't belong there. So when you do see one, you really want to approach with caution. The next thing about energy worth discussing is the 5-day rule. We had 5 red days in a row, or pretty close to that if you count the doji day, which technically speaking was still a red day. I'm using trend candles, so it colored it green, but it was still a down day, right? Or it gapped up and then it faded all day and it closed lower than it opened, but it still closed higher than the previous day's close, which is why it's green, right? Still a negative day. 5-day rule says after that, you should see a little move in the other direction, which is what we're getting. We bounced off of support, and that tends to rally us up into resistance, and then we can continue the move lower because we're not done with the move lower in energy. Just like when we were looking at that 10-period moving average and how far away from it we were, the reason I look at that is to be able to answer the question, are we overbought or oversold? Have we moved too far too fast? And could I get a nice reversal play? Just because energy happens to have fallen 5 days in a row and it had a green day does not mean we're ready to take a swing trade long just because of that, right? Like we need more than that. Otherwise, that 1-day rally that we got yesterday may be all we get, and then it just dumps right back down on your head. So we bounced off of the 200-period weekly moving average. We found support. We're bouncing on support. And all we're very likely to do is rally into resistance before rolling over and continuing this move lower. $65 is was the price target, and we got there. Now we're looking for a slight rally up into resistance and then the rollover, and we start focusing on $60. This is a significant level of support. So we're likely to chop here for a while before the break happens and we continue to go lower. In that chop, we could chop all the way up to $70, $72. We would still be bearish. So if this continues to rally higher, as long as it stays below this really big red bar, then we're still in a bearish move here in USO. So it could just maintain between 62 and 72. It's a nice $10 range. But we're not expecting it to run, above 72. There's the 200-period weekly moving average on the EMA over our head, but there's also the 50 EMA, the 50 SMA, the 20, the 10, the 4. It's underneath all of its major moving averages on a weekly chart. $63.15, we hit that support level. It held before, but we didn't get much out of it, right? Look at the rally, the gap difference here between where we closed and then where we opened, and that left a gap. Well, that gap got filled here, and now we've broken down through it. At some point, this support is going to break, right? How many times can you kick the door before the door finally opens up and we get through it? So faded back to support, bounced into resistance, rolled over, and this is on a monthly, with the expectation that lower levels are going to be in play at some point. Could you get away with putting on a short duration credit spread to the upside, or a debit spread, call debit, or a put credit? Sure, depending on your time frame, it's certainly viable. 1 day, 2 days, maybe a week. But if you're looking for a long-term swing, I think you're early. I think that this is still bearish overall, and that it won't make it back above that really big red bar. even if we did make it back above that really big bar, it still has resistance at 77, 76.5. Has to get through that. Tradable, is it doable? Sure, depending on your time frame. There is a gap to fill up here at 67.2, but we would have to get through the 10 and the 20. Be a little bit of a trick. Looking at it in the pre-market, everything else is up a lot more than this morning. So, where's the juice, right? Where is everybody? Something to consider. We're just seeing a bounce in energy off of resistance or off of that support, right? And the target is into resistance. UNG, on the other hand, is getting some fire this morning. In the pre-market, this is up a lot more than USO. Start out on the monthly or the quarterly. Bounced on that trend line. We're still sitting inside of last quarter, though. Monthly, we're still sitting inside of last month. And weekly, we are gapped up, but faded down. That's why it's not a hollow green candle. We opened it there. And so far, we've faded down to the 4-period moving average, but the gap still exists in natural gas. We're going to be looking for that gap to get filled. 1926. Here on the daily, you can see how we rallied into the 50-period moving average, and we faded down to the 20-period moving average. The candle from the day before was a reversal candle. The expectation was that we were going to come down, and then we rallied up. We have our reversal candle there, and then we would continue to move lower. And that's not what we got at all. Had a significant rally up yesterday, right into resistance. So that was a little bit of a surprise. It did close the gap that we had left back here at $21. So that gap is done. But now we've got a new gap to deal with. And if you look at this back here where we had that rally up, and we closed here, and we opened here, dropped back down, then we gapped, and then gapped again, and then gapped again. And see, it's just this very aggressive, strong move to the downside. Beautiful reversal candle. That was an outlier. If you take that one out of the equation, this is what you would expect to see. That's your real reversal candle. So we could end up discounting this candle completely and looking for this candle to be the turning candle. UNG is traded a lot nationally or globally. That's the word I'm looking for. It's a global product. So it gaps a lot because it's being traded heavily in the overnight hours. This is one of those 24-hour ETFs. There's a number of those. Things like EEM are heavily traded in the overnight hours. And of course, SPY, QQQ, But EEM is one that really stands out as a gappy bugger because it's emerging markets, so it's traded, nationally. So yeah, there was some research done a few years ago by TD Ameritrade, and they basically was looking at answering a question: if you bought SPY before the close and then you closed SPY at the open, would you make more money as opposed to buying SPY at the open and closing SPY at the close? And at the time of their research, you actually made more money if you bought SPY right before the close and then you sold it at the open because the overnight moves were so big. When it comes to these products that trade in the overnight hours, like emerging markets and natural gas, it's worth considering the size of the gap and kind of asking yourself, would it be better to buy it before the close and then get out of it at the open the next day? One, you get to avoid PDT, which is really cool, right? I like to avoid PDT whenever I can because basically, well, screw them and their stupid PDT. But two, I like the idea of making money, so yeah, I mean, it's certainly something to think about. I didn't keep the link to that article, and I really wish I had, because I've wanted to go back and read it at some point. I wanted to dig deeper. It did come from the ticker tape, which is TD Ameritrade's publication online. So if you go to the ticker tape, I don't know what necessarily you would search for to find that, but I think it was in an article where I was reading about these gappy markets, EEM, and I think they were advertising their 24-hour ETF watch list, and that would explain it too, right? So if you go to public 24-hour trading, they have a watch list built for that, right? And you can see the little emblem next to it where it says 24. That lets you know that it's a product that you can trade 24 hours a day. Dun, 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 dun. Captain Obvious. It's not a massive list either, which is helpful. And it also matches, like a lot of the things that we look at on a day-to-day basis. So if I was going to go searching for that article, that would be the place that I would look, because I know it was from TD Ameritrade. That's a good place to start. So if you guys are considering this YOLO play, and by the way, I'm gonna put together some back testing on something one of my coaching clients had asked about the SPX, because their options values, just the change percent is so radical. Their question was basically, could I just go out of the money on a week-to-week basis and buy a call and buy a put, and whichever way the market goes this week, one side is going to lose and the other side is going to win. And on the losing side, we try to close it as soon as we can. But on the losing side, we let it run and get as much as we can out of it. If you've traded the SPX, you know that it is an expensive bugger. This thing is costly. But if you do get far enough out of the money, you can find, 70 cent, 80 cent, $1. You can find options, that don't break the bank. The thing is, the move that you would need to see for these options to become even remotely profitable is enormous. I mean, it would take a significant move. And if you've got one on each side, they could both lose. And the question was, in this bear market environment where our day-to-day movement is just so big, wouldn't this strategy work? Because in theory, since we get such extreme moves up and down, you could technically see profit in both just as easily as you could lose in both. I think it's a fair question. I'm going to flesh that out a little better by using Options Omega. Their backtesting platform uses intraday data, which is like unheard of when it comes to backtesting. And we'll be able to dig deeper down into this and get a more detailed answer. We could use, the old school end of day data but I don't see why we would do that, right? Like we got access to such powerful tools. I want to use them. So hopefully I'll have a video like that probably by the new year. You know, we got the holidays coming up and some things that are likely going to require a bit of attention, but we get some free time. I think that'd be a good test to run. And it'd be an interesting thing to check out. Between now and Friday, however, and even kind of even go a little farther down the road, because like we've been saying, if it's bullish today, or really if it's bullish tomorrow, it's going to run all the way into the new year. Now, January, we're likely to dump like a stone, but if this turns bullish, it's not likely to stop before Christmas. The same thing with bearish. At the end of FOMC tomorrow, if it's bearish, it's very likely going to stay bearish all the way into the new year. So going out of the money and thinking about, you know, buying a put in the SPX at say 3,600 or 35.5 using December 30th or something like that, you know, going out as far as you can into a price range that you're comfortable losing, I don't think it's out of line. It is a YOLO play, right? I mean, this is like good luck. But the possibility that these are going to monetize, that's a fair and legitimate possibility. Just because the move is anticipated to be record-setting epic, up or down. And remember, price doesn't have to go all the way to that strike before they monetize. The ones that I bought, the calls yesterday were already seeing, you know, 10 and 20 cent profit, even just before the explosion. You know, I was seeing 10 and 20 cent profit by around noon or 1 o'clock, considering I bought it, you know, on Friday afternoon, late in the day. It was already seeing a little profit just from that little bit of a move. So, you know, something to consider. And it doesn't have to be the S&P, but you're going to want to find something as liquid as possible that has the most strikes available. If you did want to wait until the numbers come out and then purchase something like that, my recommendation is focus on things, if we're bullish, focus on things that have been beaten down a lot. Meta, PayPal, Nvidia, things that are down. Because if we're going to be bullish, you want to pick on things that have a lot of room to run to the upside. But if it's bearish, if the entire thing just starts to unravel, focus on things that have not made the really big drop yet. Microsoft, Apple, you know, even Tesla could kind of be put into that pile, but Tesla's had a drop. You know, it's not as strong now compared to its peers. But Apple and Microsoft are like the last two holdouts. So if this does get really bearish, this is, I mean, it's already what I'm holding short, but this is what I would probably add to in my shorts. It's very likely going to be, you know, a move talked about in the history books. And although I disagree with what I'm about to say, it still needs to be said. Price can do whatever it wants. And we could get a market that doesn't go anywhere. It could get violent and jump around for 1 or 2 days and stabilize pretty much right where we are, right where we've been, right in the range. So it really does not owe us some big, epic, monster move. I don't think that that's what we're going to get, but we need to say it. We need to recognize it. It does not owe us a move. There really isn't anything else to look at. The CPI today is going to be the name of the game. Just like yesterday with those flows that came in, if you're wanting to see at least something like that, on the Visualize tab, if you go to the Index Watch, this is like an advanced decline line, but has the money in it. You can bring up something like the NASDAQ 100, and you'll be able to see the number of issues. Issues are companies. I took a picture yesterday of the issues and posted it in the chat, as I generally point out those. This is what it would look like on an intraday, and you can look at more than one at once. So there was the S&P 100, and there was the NASDAQ 100. The issues are companies, and then you can see the money flow. So we had 85 out of 100 moving to the upside, and yet the money flow was just really negative at the time. It all turned around by the end of the day. This was taken at around noon, I believe. We'll check the timestamp in a moment. But you can literally keep track of divergence, money flow, and then, you know, chase it down the rabbit hole and see where the money's coming from or where the money is going. This was really divergent yesterday, which is why I took the picture and threw it in there. The money flow was really negative, and yet the issues were more positive than negative. So that was our divergence. That came in 12:48 my time, so that'd be 1:48 market time. We're still seeing some really crazy stuff with the VIX moving higher and the S&P moving higher at the same time, which is throwing off a lot of stuff. And the dollar is still disconnected from what it has been this year. So, you know, using our tools the way we normally would is a little off. And that's just the way it is right now. But everybody, be careful, be safe, and I will see you all tomorrow.